Welcome to another episode of Rich Dad StockCast. I'm your host, Denney, and if you're serious about improving your financial education, you are in the right place. Today, we're uncovering a topic that a lot of investors overlook, and that's dividend investing. Now, before we get started, remember to like, subscribe, and drop a comment below. Your feedback helps us to bring you more of the content that you want to hear. And also, don't forget to visit StockCastBonus.com for free resources to boost your financial knowledge. Joining us today is Rich Dad expert Andy Tanner. Andy, welcome back to the show.
Thanks for having me, Dell. This is one of my favorite topics. I love sharing what I think I know, so far, what I've learned so far in this realm. And I think it's one of the most underrated, overlooked, and dismissed sources of income. I think it's misunderstood, not only not understood, but often misunderstood by many, many investors. And the power of dividends is significant. And if you're going to be in paper assets, we should not dismiss their power.
I can't wait to dig into this. I can't wait to pick your brain. So let's just dive in. Dividend investing is a strategy that a lot of people overlook, just like you said, but it can be powerful. It can be, create consistent income. Let's start this way. Why is dividend investing such a game changer for building long-term wealth?
Well, it is the foundation of cash flow. If a person really, I think it was Charlie Munger, the late Charlie Munger, who said, if all you do in life is get rich by buying and selling little pieces of paper, it's a failed life. By being shrewd, life is more than wealth accumulation. By buying and selling. And there is a I would almost call it a disease, a mental health issue almost. If we were to turn on CNBC right now, they'd be talking about the price of a stock, 1,000 hours to one of dividend. They just would. It's 1,000 to one. It's got to be. And this obsession with price movement and buy low, sell high, high frequency trading, buy low, sell high. That's kind of what Munger's talking about, I think, or was. But a dividend is more like a real estate mindset, which I really like. So let's define what it is so we know what we're talking about first. Maybe that'd be a good way to start.
I was thinking the same thing. For those that don't know what a dividend is, can you just kind of start with the basics for us?
Yeah, let's talk about the word divide. That's where the word dividend comes from. And my wife and I have invested in real estate as well. And one of the investments we make is in syndications. So what is a real estate syndication? Well, it's a group of investors that come together and they invest as a team, so to speak, in a real estate project. So maybe there's a project that's got, 250 units or 300 units. And someone's going to raise some money from the bank, but they need some equity to put down on the property. And that'd be a lot of equity. It could be tens of millions of dollars, and it could be 100 million in the project or something like that, 75, 100, whatever it is. So what'll happen is they'll go to private investors and they'll say, hey, let's say you guys sitting around this table are all going to invest in this project together and we'll all get a share. And that's a beautiful word, share. The idea that we can do more together than we could do as individuals is a beautiful thing, that we could share in the cost, that we could share in the risk, that we could share in the ownership. We could also share in the benefits and in the profits. And so in this real estate syndication world, they rent these properties out, they renovate them, they update them, they give us reports on, we're going to paint it this summer, or we're going to upgrade the dishwashers, whatever it is, trying to raise the value that they give to people so they can raise the income that comes in. And if at the end, there's what we call a bottom line, where we add up all the things that cost us and all the thing we earned, and there's a bottom line called bottom line earnings, net earnings, profit, whatever you want to call it. There's this pile of cash. And what do? We distribute this cash. There's a word, distribute, divvy, divide. whatever D word you want to use. And so like a card dealer that deals out the cards, that divvies up the cards, that distributes the cards, that divides the deck, whatever you want to call it, everyone gets a share, and that's called a distribution in real estate. I'm providing a value, and it is a business. In Robert's book, Rich Dad's Guide to Investing, there's early on in the book, he talks about a seminar he was giving in Australia where someone came up to him. It's a 3-day seminar, and after the second day, he says, all you've talked about is business. You haven't talked about investing. He says it's the same. It's all business. Investing in real estate, you invest in syndication. It's a business you're investing in. It's a limited liability company, usually with a limited partnership. It's an entity. It's a type of, what is a limited liability? LLC is a corporation. It's a limited liability corporation. It's business. Well, in stocks, it's no different. We have a group of people, usually much larger, much bigger game than a syndication. Now we're talking about hundreds of billions instead of tens of millions, hundreds of billions. We can do more together than we can do apart. We can share in the risk and we can share in the benefit. And the idea that we would divide the wealth of these companies among its owners is a really beautiful capitalistic idea. Government wants to divide the wealth via taxation. I'd rather divide the wealth by ownership. I would rather teach our citizenry to own part of this GDP, to own part of this, rather than to try to tax and redistribute. I would rather redistribute the ownership of these companies and distribute their profits, divide these profits via dividends to owners. There is absolutely no reason, Del, absolutely no reason that the wealth of this country could not be divided up via dividends. It absolutely can and should be. What is the deal with that? Well, we teach people in freaking school to go work for these guys rather than own them. And the amount of time and energy they put in is to perform labor for these companies rather than to work to own them. They work for the money instead of working for the ownership, work for asset. And I have a lot of hopes. I mean, I don't know. It's a gamble, I guess. But I look at my sons, they're teenagers. And they've got the mentality of accumulating part of this ownership throughout their life, over time. Every single year, they want to own more shares than they own the last year. This has nothing to do with Wall Street. They don't need to go to Wall Street to have their money managed. This is Warren Buffett. Here's a guy in Nebraska that simply purchased, and here's one guy, it's equivalent to 5% of the S&P because one guy just started buying stuff. With the profits, he bought more. We can all do this. There's no reason for BlackRock. There's no reason for Vanguard to own all this stuff. Why do they own it? Because we give them their money and they take the fees. And what do they do with these fees we pay them? They buy assets with it. And since they have no risk, they get these dividends. And so it's divided up the wrong way. The dividends are divided up. If the citizenry would own Apple and would own Google and would own this, they'd get these dividends too. So don't get me started, on this idea that dividends wouldn't. Dividing the profits amongst us, will go buy some shares. Don't expect it for free. Don't be entitled. It's a fair exchange. Buy some shares and enjoy those dividends. So what is a dividend? It's dividing up the profits of corporations. It's dividing profits among everyone who shares and who has a share of this economy and who has a share of this business. It's a beautiful thing, I think.
I think it's a beautiful thing too. I see you getting worked up on it, which I get. I understand. I love the idea
of water or something.
I love the idea of buying into a business, being a shareholder, getting money back, getting that.
That's dividend. What a dividend is.
That's what a dividend is, right? And there's a great book called The Millionaire Next Door, and I have a friend, he's since passed away, but he was a dividend investor, and you would never know how much wealth he had because that was his strategy. Now, I knew that he targeted certain sectors because they were better at paying dividends. And now, Andy, is there certain sectors that you see that are better at paying dividends than others?
Energy pays a decent dividend. REITs pay huge dividends often, real estate investment trusts, but I don't think REIT's more of a retail product. If you're going to buy real estate, I'd rather do a syndication or even my own, just buy a single family home. But, energy, they tend to give a good dividend. Tech, some, yes. If it's a growth stock, less of a dividend. But I'll tell you where people, I think, miss it. Excuse me. I'll tell you where I think people miss it is they'll look at a dividend and think it's too small. And this kills me. They'll say, well, this dividend only pays, 4%, and inflation's 2.5% right now. So what am I really getting, right? And what they miss is it's so crazy because people will speculate on the price of a stock going up in the future, but they won't speculate on the size of a dividend going up in the future. It kills me. Let me give you some context. It's not the dividend yield, it's the investor yield. It's not the dividend yield, it's the investor yield. So this might be something we have to I don't know how close we are to break. Maybe this is too big of a topic to go into before break, but it's not the dividend yield, it's the investor yield. So let me kind of set that up a little bit. Warren Buffett, I'd have to look it up. I should know this because I own a lot of Coca-Cola, actually. I own a lot of shares of that. That's a big part of my portfolio is Coke. And I should know what it is, but I want to say it's like, it's probably a couple of dollars a year, maybe $1.95. I don't know what it is. I'd have to look it up, but it's a nice dividend. And I think Buffett paid $3.25 is his cost basis. So someone buys Coke now, at a high price. Buffett, before splits, his cost basis is $3.25. So here's a guy that spent $3.25, and now he's getting $2 a year from that investment. I mean, the thing's paying for itself every 2 years plus some, right? He's an infinite return. Like that thing is paid for itself a million times. And so it wasn't paying that when he first bought it, but the growth is there. And really what you're doing is you're betting on inflation. You're betting on that the cost of goods will go up, but also the price of the goods will go up, and the margin, the earnings margins will also increase. The difference between the cost and the income will grow as well. And so you're going to get a dividend, and that dividend will grow. Let me give you an example. In COVID, maybe it's not so much the sector, but it's the pride that the company seems to take in paying a dividend and increasing it over time. So in COVID, I tell the story often. In COVID, one of the best stocks I picked up was ExxonMobil, and my cost basis is probably somewhere in the 40s. With all the options premium, it's probably way lower than that now. But back then, with I bought it, and then I bought some puts on it to protect it, and the puts paid off. So I'm probably in the 40s somewhere in cost basis initially within the first few months. Well, ExxonMobil's had an increase in their dividend every single year. I think it's probably 37 years in a row. This is like when I was in high school or further, right? I mean, they've never had a year in my adult lifetime where they haven't increased their dividend. They're so committed to paying it, so committed to it that when COVID hit and all of the oil futures got jacked up because there was no place to put the oil. We had so much supply.
Yeah.
There's no demand. I mean, no one's driving to work. The trains have stopped. The airplanes have completely stopped. In COVID, there's just no oil being used. So now we got oil, and an oil future is a promise to buy the oil and a promise to receive it. It's not an option. It's two promises: a promise to buy and a promise to take delivery. So all these speculators on oil have promised to take delivery. They've committed to take delivery, and they're speculators. They don't even have enough room in their bathtub for oil right now. And so as a result, they had to pay people that had storage, and oil went negative. You could literally get paid to simply take delivery of oil, not just for free, but they would pay you to take the oil off their hands, and it went negative. So how is ExxonMobil going to make any money when the price of oil is negative? Like you can't give it away. You got to pay someone to take it. How do you do that? They still paid a dividend. And the reason they paid a dividend, they were so committed to it that these guys went out and they sold bonds. They sold corporate bonds, knowing the oil would rebound. And their dividend was maintained throughout COVID, and it was increased throughout those years following COVID, and it still increases today. So the idea that someone would be forward thinking in the stock price, so the stock price is going up, and not have a belief that there's a high likelihood. If you look at Exxon's chart, it's all over the place, right? It's all over. Dividend, it's just steady. It's just a steady upward movement. And so yeah, I love the idea of dividends because it's a forward thinking, inflation benefiting instrument. Go back to Buffett, $3.25. He's getting around $2 a year now in dividend. So when we come back from break, maybe I can see the producers telling us time for break. But I'll let you take us in a break.
Well, let's do that. Let's take a quick break. But hey, listeners, don't go anywhere. We've covered the foundation of dividend investing and why it's so powerful. But when we come back, I'll ask Andy how we can unlock the hidden potential of this strategy and turn it into significant passive income, kind of like how Warren Buffett does, right? Stay tuned.
So far, it's been great. I needed a source where I could really enrich my education through stocks. I didn't really have an avenue for it, and it's helped me a lot. The simplicity has really gotten me on the track to where I enjoy the learning as well as it's really solidifying in my mind. And like, they're not just trying to sell you something, they really care about the people that are in the course, and they really do care about you and your personal goals, and what you want to do is to help you and your family and whatever your goals are in life through that. So it's really been great.
All right, folks, welcome back to Rich Dad StockCast. All right, Andy, for those that are ready to dive in, okay, what are some practical steps they can take to start tapping into the hidden potential of dividend investing and start generating passive income?
Yeah, specifically, you start with 4 pillars as always. We want a good fundamental company if we're going to pay dividends. In the book, The Intelligent Investor, it's such a great book. You know, it was written back when equities were not as popular as bonds. And there's a huge, thick book called Securities Analysis by Benjamin Graham. And that thing, you know, Intelligent Investor is about that thick. Securities Analysis is about this thick. It's a doorstop, man. That thing, throw it in front of a bus and the bus will crash. And it's certainly not light reading at all. But it's an interesting book because Securities Analysis deals with mostly bonds. And the idea behind a bond is you're loaning a company money. Well, what gives you the confidence that company is going to pay you back, right? If you loan someone money, what gives you the confidence? Well, it's going to be their own financial strength. And there is a section in there on dividends, on equities. It's a smaller section of the book because securities analysis is about business analysis. And if you think about the ability to pay a dividend is going to come out of profits, and the ability to pay a interest on a bond is going to come out of profits. And so if you want to invest in dividend companies, you'd approach it the same way you'd invest in corporate bonds. You'd want to do a securities analysis and feel very confident that the money would be there. So the 4 pillars is key from fundamental analysis is we want a company that's profitable and that's growing. The other thing is Warren Buffett. I've gained a greater appreciation for this the more I've studied it, and I think I'll continue to get a appreciation for it as I get older. But Warren Buffett talks about the concept of a moat meaning a protection of the castle. And a moat is not so much a nebulous idea, but it's certainly not. It doesn't always look the same for every company. It's kind of a thing that it's there when you see it, but it's hard to describe. So, for example, he talks about Coca-Cola a lot. Well, first, they're selling 2 billion drinks a day. That's pretty powerful. If you got that many caffeine addicted people, 2 billion a day, it's just hard to take down that castle, because it's, people are going to go to McDonald's and they're going to get a Big Mac and they're going to get Coke. It's just part of the deal. It's just part of what they're going to do. And to try to insert Pepsi in that, or to get a different drink other than Coke, it's hard. They've just got a really strong castle, a strong guard, and a strong moat. So for dividend investing, we want to have great fundamentals, and we want to have a company with a great moat. We want an income company. Growth companies like Tesla are not going to, Apple was that way forever. And like First Solar needs to be that way. There's certain companies that will eventually, they get so much money that the investors say, hey, you got to start divvying this up. So one of the metrics to look at is something called payout ratio. Now, this is where stocks are a little different than real estate. Is in real estate, they really have to pay out a lot in their payout ratio. Usually it's whatever they can afford, right? They keep a little bit of money for maintenance, a little bit of money for rainy day, but they're trying to pay out as much as possible. In stocks, they really vary because in a business, often there's innovation. Even a company like Kraft Heinz needs to innovate. If people get tired of mac and cheese and the perception changes, it's an unhealthy food and it's not a great staple, they've got to innovate. So you'll have less of a payout ratio generally in stocks than maybe you would in real estate. But it's just simply the ratio of profits that go back out to the investors. And I like having a little room in that. I like seeing that, golly, they could really keep paying this a lot. They have room that if they hit tough times, they can still pay, which kind of goes back to securities analysis. Do they have the ability to pay? Now, some have such a commitment to it that they'll pay, over 100%. They'll even, dip into other coffers to pay investors. And that happens in, I remember a friend of mine said, well, isn't that dangerous? I go, well, real estate investors are doing that all the time. There's more debt in those real estate companies than you have. There's more leverage there than you often have in stock corporations. And they will refi to pay a big old distribution out. And it's borrowed money. And it's nice because that stuff in real estate often isn't taxable. So the idea that people would borrow money to pay a distribution is in real estate all the time. Does happen in stocks, but I like a payout ratio, and we can teach you more about payout ratios. But I like one that has a little room to it, that says, hey, if they fell on hard times, they could still pay me my dividend. And so there's always more to learn, but you're not looking for a growth stock, you're looking for a dividend stock. And what I'll do a lot of the time, what my sons will do, is you start that as a cash flow baseline. So let's say you get a company like Verizon or a company like Exxon, you got a 4 to 5% dividend in some of those. That's just simply a foundation. Then you want to look at maybe some covered call writing that's very conservative. It can be done in an IRA, and you try to get another percent or so, every month or 2 months. And next thing you know, you've got 10, 11, 12% as a foundation. And that doesn't even count your capital gain. If you learn a little bit more about options, you push it a little further based on what you learn. So for me, from a cash flow standpoint, I love dividend stocks. And I love dividend tech because usually tech has enough volatility in it that you can get some nice option pricing. Energy has enough volatility in it. You can get some nice option pricing, and you just stack. It's just a stacking of income on top of each other. You start with the first stack is out of your dividend, and your next stack, comes from one type of option strategy. Then another stack comes from a supplemental option strategy, and you start building cash flow. And the capital gain, it kind of takes care of itself. I don't have any plans to sell any of my dividend stocks. Why? Said nobody. Can we go an episode without a goose, the golden egg reference? I don't think we can. Said nobody ever, I think I'll buy this goose that lays the golden egg because I think the price is going up next week and I can sell the goose for a profit. I'm going to flip this goose. You know, that's the new reality show. Flip this goose on A&E, right? Flip this goose. No one said, let's flip this goose.
No.
Someone said, let's buy this goose, take the eggs and buy more geese and compound. And that's what can happen. Last thing I'll say, you know, on this little segment, you know, if you buy a stock with a decent dividend, like a Dow, you know, Dow pays 70 cents, that's 280 a year. Well, that's another one I picked up during COVID, and that thing's paid for itself through option premiums. So if you think a dividend is too small, what if I did this? What if I said, Dell, I'll be your Uncle Andy, and when I die, I'll leave you all my shares of Dow 4 years from now. You get them all. Here's the condition. You don't have to pay for them. I'll bequeath them to you in my will. I'll give them to you in 5 years. But you can never sell them. All you can do is collect the dividend. You can reinvest that or you can spend it, but you get the dividend for life. What's to lose on that deal? You put no money in the deal. You're an infinite return. You have no money in there. Zero money in and a dividend out. Do that math. Division by zero is infinite return. You would take that deal any day, yes?
100%.
I mean, if I gave you all my shares of Dow 4 years from now, you get them and you don't have to pay anything. And you'll have no money in the deal. You'll have no risk in the deal. You're not allowed to sell them, but you can collect the dividend the rest of your life. You take it?
I'll take that deal, Uncle Andy.
So what's the difference? I mean, COVID was 4 years ago. I bought that stock, and through options income, through cash flow strategies, you paid for. It's paid for. So now I get that the rest of my life. I have no more money in it, and I get to pay that, or I get to receive that dividend no matter how high it may go. And if it's in the family trust, then my sons get it, and then their daughters and sons get it. What's wrong with that idea? That's a great idea. And yet people poo-poo dividend. What do you think that dividend's going to be 20 years from now after I'm dead? You know, maybe I make it 20 years. I don't know. But 30 years from now, 40 years from now, whenever I'm dead, that thing's still going to pay legacy. I mean, that thing's going to pay out as long as that company stands, and it'll outlast me. I can't bequeath a job to my kid like that. Ownership, owning assets, getting the dividend. Don't underestimate that on what it can do. It's pretty cool stuff. It's a significant part if you know how to stack the income. It's a big part of that stack.
Well, speaking stacking the income, you talked about covered calls earlier, which is kind of another one of those strategies that, you know, not too many people know about, but they should. And they go to stockcastbonus.com, learn more about it. But I want to go more back to something that you mentioned earlier about emotional intelligence. And, you know, I think patience is key when it comes to dividends. Because I remember early Denney investing in stock market. I tried to do some dividend investing. I saw the returns. I wasn't patient enough. What would you say to other people out there when it comes to patience, when it comes to this strategy?
Be patient.
All right.
Right. You know, I mean, look, I don't know. I think Robert Kiyosaki went hunting with the Trump sons, and he's pretty good friends with that family. So he's out hunting, shooting something with the Trump sons. And he said to me, you know, the number one word in that family is aggressive. So I don't know that is the same as patient, right? The number one word he says in that family is aggressive. And I would say this, when I play basketball, I'm aggressive, but at the same time, there's an element of patience that coexists with that aggression. When I play a basketball game, I remember the first trophy I got as a kid. You know, I had a coach that thought everyone had to have a trophy. And so he'd come up with something, you know, this guy was the best this, and this guy's the best this. And I got the trophy most aggressive. I don't think I was, but in my little, you know, 8-year-old mind, I thought, hey, I'm aggressive. But I'm also patient offensively, right? That's called shot selection. So when it's time to go, you're aggressive, but you let the ball find you. And when you're open on balance and you're in range, then you know that's a good shot and you're aggressive with scoring the basketball. You don't shy away. So I think there's a balance of patience and aggression. I'm very aggressive. If you have cash, to go put that in. If you have extra cash, go put it in assets. Be aggressive with that. But at the same time, be patient in knowing that your dividend is a bet on inflation, basically. It's a lot like real estate. I'm going to buy this house now with a belief that 30 years from now the rent will be higher. And the amount of money I put into it was one time, right? I bought it once. You buy a house for $300,000 or whatever you pay for it, $400,000, and maybe you're getting a couple of $1,000 a month in rent now. You're just believing that with inflation, the rents are going to go up, that that there's going to be a margin there that's going to work for you, that as you refi it and pull money out tax free, that you'll still have a good profit margin where that cash flow increases. It's a bet on inflation. I don't see it any different with dividends. I'm betting on inflation, and I'm betting like someday you'll be in a Warren Buffett situation where he paid $3.25 for the stock, and he's getting around $2 a year dividend now, or whatever it is. There's no question that someone might buy a $40 stock today, and 20 years from now they're getting a $10 to $15 dividend a year. That's not impossible, especially with the stock splits and so forth. So yeah, it is. I don't know if it's so much patience, Del. Maybe a better word than patience is having a vision and understanding a vision of the future, right? And being forward thinking. Maybe it's not just patient. Maybe it's just being clear-headed about the future and seeing where things will probably go and taking advantage of that aggressively.
I like that. I think that's probably one thing I lacked early on, and maybe some early investors do too, is that vision. Because when you have a vision, then you're aggressive towards that vision. So I love how those two go together.
That might be kind of cool. That might be a better way to think about it. Is it's not about being patient; it's about having a vision of compounding and having a vision of inflation. That might be the key to it. But dividends are awesome, man. If listen to Warren Buffett and how he talks about it. I mean, when Kraft Heinz, he paid $70 in the 70s for when he helped with the merger of Kraft and Heinz. He paid $70. He came out in his letter, said I paid too much. My fault, because it fell. They had some impairment costs. They had overvalued the Kraft brand, basically, and some of those brands that were there, particularly Oscar Mayer. And so on their balance sheet, they had to reduce what they felt that brand was worth, and it was an impairment cost. Took their stock from 70 to 30, and that's when I bought it. And Buffett said, yeah, but I'm keeping it because the dividend, I get a consistent dividend from it. And it's a big part of our cash flow. We get so much money as owners of that company. I don't care about the stock price. It's still worth it. Wish I hadn't paid 70, but the dividend's still awesome. And which gave me a lot more confidence to buy in the 30s.
Yeah, no doubt. No doubt. All right. Well, that is a wrap for today's episode of Rich Dad StockCast. We hope you found our discussion on dividend investing helpful. I know I sure did. I learned a ton. Andy, a big thank you to you, as always, for sharing your insights with us today. I loved picking your brain. Now, remember, whether you're just getting started or already building your portfolio, staying informed and educated is the key to long-term success. Don't forget to visit stockcastbonus.com for free resources to help you along your journey, like also learning about covered calls and all that good stuff. And if you've enjoyed today's episode, please make sure to like, to subscribe, to leave us a comment. Your feedback helps us to bring you more of the content that you want to hear. And don't forget to share this podcast with your friends and your family. It can help them to make better decisions too. So thanks again for tuning in to Rich Dad StockCast. Until next time, get smart, get invested, and take control of your financial future. I'm Denney, and we'll see you on the next episode.
This podcast is a presentation of Rich Dad Media Network.